let's see, fuzzy lines, the blurred lines between fintechs and banks. So as many of you guys know, there's been the separation between banks and fintechs was initially very competitive, and now it seems like over time it's becoming more collaborative. So we're going to talk about both sides of that in this panel. We have Ryan Anderson from Deloitte that will be leading off this panel. At this time, I'll hand it over to him.
Thanks, Brett. As Brett said, I'm Ryan Anderson. I work at Deloitte & Touche in our audit practice. I work with financial institutions, banking and securities, historically on more of the traditional side, I would say, and more recently on the kind of getting involved in fintech and working with some startups on the audit side, helping them if it's IPO readiness, if it's regulatory compliance, and that kind of thing. So I'm excited to be here, and I'll moderate the panel. But real quick, I'll pass the mic down the line. I guess they all have their own mics, but they can introduce themselves.
Hi, I'm Sankaet. I run this company called Synapse. We build out banking APIs. So the idea is to allow any company who wants to build banking/finance products into their application, just integrate with us and launch their banking product. It could be doing payments or opening up deposit accounts, issuing cards, what have you. Pretty much the whole stack. You can build that with our APIs.
I'm Lisa Violet. I'm the Chief Risk Officer of Federal Home Loan Bank of San Francisco. It's a bank no one's ever heard of. We actually are a cooperative of about 300 plus members, ranging from SIFIs to super regionals to traditional community banks, credit unions, and specialty financial institutions and insurance companies. And my role here on the panel is basically to be the glue. We are seeing a convergence of fintech. We don't see competition, we see connectivity. Our members are experiencing it in a couple ways, but how we see it, we are a liquidity provider to our member institutions. They usually are deposit insured takers, and they pledge collateral, so we're basically liquidity providers with collateral. And those deals that they're sourcing, a lot of it is starting to come from fintech players as third-party originators. And then on the platform side, there's a tremendous opportunity here right now, with the companies that are part of the whole digitization to increase the mindshare of our members. Certainly the big players are already there, moving fast, but the smaller players. So that's what we do, and looking forward to this panel.
Good, thank you. PJ Gupta, founder of Checkbook.io. We do digital checks. Contrary to popular opinion, paper checks are not going away. They're still there, and they're being sent, and if you're on ACH, that's great, but if you're not, getting rebates, getting class action lawsuits, and then going to your banking portal and sending out a bill payment still sends out a paper check that takes about a week to get delivered. With us, it's instant. We send an image and email, and the recipient has two choices. They can either print it out, or better yet, they can deposit it online instantly, and they become online consumers from offline to online. The ingress points to our system are either through accounting systems like QuickBooks or through banking partners. Instead of, again, doing the bill pay with paper checks, you do it through digital checks. We're a startup, Series A stage, and love to be a part of this panel because banks and fintechs, yes, I believe at a high level there's collaboration, but I won't be afraid to say where there's could be competition too, and definitely looking forward to talking with all you guys.
I'm Zach Smith. I am VP of Product at a startup called Chime. Chime is essentially a bank account. We offer checking account and savings accounts to our members. We have about 500,000 accounts. We just closed a $20 million Series B about 2 months ago. So we're definitely one of the leaders in the challenger banking space. We ride on top of a bank currently, Bancorp, for many obvious reasons, as most kind of startup banks do, but we're growing very, very quickly. Really geared toward, most of our members are making living paycheck to paycheck, as most Americans are, and we have a set of features like we never charge you fees, and we give you access to your paycheck a little early, help you save a little money automatically. That's maybe a lot of people in this room, not a huge differentiator, but is beloved to a shocking degree by our members. I've never worked at a consumer business with as high NPS and engagement as we sort of see from our members. So definitely feel like Chime has found product market fit in serving the needs of, say, half of America that's really pretty poorly served by consumer banking options today, and specifically the fee structures that a lot of these banks impose. And there's really interesting reasons we, I guess, can get to about why that is. But yeah, good to be here.
I like how you said you currently sit on top of a bank, as if, you know, maybe in the future that could change. Yeah. So just a quick backdrop. We'll dig into this. As we know, there's been disruption in the industry. There's a lot of ways you can look at this panel, where we can go with it. One of the focuses that I thought would be of interest would be defining the customer a little bit and understanding our banks, financial institutions, traditional banks. Are they looking at the same customers and serving the same customers that some of the FinTech, maybe a Chime or some others are looking at, or are they different customers, underbanked customers, or not served well customers? And so I was going to actually ask Chime or Zach if you could weigh in on that first, and then we could kind of bounce around a little bit.
Yeah, so specifically whether the customers we're serving are the same as the ones that the big banks are serving. Yeah, so Chime is not targeting the unbanked. Our founder actually has his background in the prepaid card space, Green Dot, if you're familiar, and they feel strongly that they're providing the dignity of a cash card to their members. That's not really who we serve. We target people who steadily employed, use Chime as their primary bank through direct deposit of their paycheck into their account, but certainly have honed in on the segment of Americans. Again, I call about half of American households that are maybe making in the 40K or sort of under range of income. For really interesting regulatory reasons, big banks, it's very hard for big banks to actually serve these customers well. The Durbin Amendment to Dodd-Frank caps the interchange that banks can collect on debit card spend. So there's a couple different ways to monetize a customer in banking. Obviously, if they have lots of deposits with you and you're checking your spending account, banks get that at a very low cost of capital and can lend that out. Most Americans have no assets other than their home. So that's not a great way to monetize the people we're going after. You can monetize interchange, which is our business model. So when members take our debit card, which is tied to their checking account, and spend it at a merchant, we earn somewhere between 1% and 2% of whatever they spend. And for us, it's a really aligned business model because we make money when they spend it on their card. But big banks can't have that. The Durbin Amendment to Dodd-Frank says you have more than $10 billion in assets, you get it's like 20 cents plus 20 basis points, something like that, which is nominal compared to what we're able to collect as as riding on top of a smaller bank. And then the other option is fees and cross-sells, which is how big banks make money from their customers today. The average American pays more in bank fees a year than they actually have in savings. Some controversy around that statistic, but essentially paying about $300 a year in fees, mostly overdraft, also out-of-network ATM, monthly maintenance fees. Bank of America now charges something like $15 or $20 a month if you have less than $5,000 balance in your checking account, which is like kind of crazy. But banks have been forced into this to some extent by regulation, and it creates a very antagonistic relationship between big banks and the customers that we serve. The other option is upsell or cross-sell onto mostly lending products. And so if you look at how banks have monetized consumers since the financial crisis, a lot of it is credit card debt's at an all-time high, and banks love getting people onto credit cards they're maxing out, rolling over, and paying ridiculous APRs on. So if you step back and look at the banking landscape, it's a pretty dismal in terms of the relationship potential between, I would call, the average and below American and these big banking institutions. Chime takes a very different point of view. Like, it's very easy to get lost in the economics and of interchange and things like that. Like, we look at it from the standpoint that the defining challenge of every living American generation right now is their financial health. Across 4 areas: saving, spending, investing, and borrowing, the statistics are dismal. We believe that your bank should be and is the only one really positioned to be your partner in helping you get those 4 areas of life under control. Big banks don't really have an incentive to do it, and we think that the bank account of the future is going to look fundamentally different than this place you pay $400 a year to today to kind of store your money. We want to help people automate their cash flows from the time they get their direct deposit across those 4 areas, and think that there's just an immense opportunity there, and that you'll see this great unbundling of the bank is going to come back together, and we want Chime sort of to be the hub. Sorry, is that too much?
No, that's helpful. I was I found interesting, I think you said $40,000 income or is around kind of the sweet spot, I guess, of the, thought that was interesting. Just something I was thinking about, maybe I'll push it on to someone else here as far as a question. But is that, as time goes on, right? We're here now in 2017, and as those $40,000 earners are going to make $100,000, $150,000 or more, do we as a group see that as is there a transition period where they'll go back to traditional banking and because they'll be served well by those banks? Or will those individuals continue to be more interested in the FinTech digital space?
Yep, maybe I could lend just a perspective here to build on what Zach said about, what's that pie, and, is it taking a slice of an existing pie, or is the pie going to grow? And, Federal Home Loan Bank, as I mentioned, is constituted of member banks. And what I could share we're seeing is, Zach is right, there is a segment being served, well served by the FinTech players that are disrupting banks that have maybe forgotten about that customer. But we're also seeing, though, at a certain inflection point of earnings, somebody with more money may want to buy a house, and with that they get a mortgage. And that next offering, if you will, those FinTech players then get a whole bunch of mortgage loans, and then they need to offload it. They either go to the securitization platform, or they go back to traditional banks and sell those loans to those traditional banks. And then it becomes, well, who owns that customer? Is it the originator? Is it the new relationship? So we're building on the retail side and, what level of income. You then build on that, what other products, and, this third-party origination source, some of these players then go on to send that business over to a traditional bank. And, some of these other FinTech players that are in the space of originating loans then get really big and decide they're going to make a play to become a traditional bank. And if you look carefully, some of the really big players like a Quicken is partnering with Chase and Charles Schwab. And so there is symbiotic relationship there, and at one point heavy competition. And I think what Zach has with Chime is that interesting conversation about what happens to that retail customer and who owns that customer, what happens to that customer. So there's the retail play, there is getting into more collateralized loan plays, and then there's the kind of super critical mass aggregation partnership, or you kind of go out on your own place. So we're seeing a broad spectrum. So I think we're in different points and different inflection parts there.
So my take on this is, let's look at it from the experience standpoint. What is the customer experience? And when customer, it's a different genre for individuals versus businesses. So let's look at individuals. In terms of the, if you look at FinTech broadly, the experience is selling. I mean, if you look at what the big bank portals are like today, or even 2 years back, and with the ease and convenience that you see with all the FinTechs, that whether it's banking that Chime's offering, whether it's investing, whether it's payments that we're doing, any subdivision of FinTech, the user experience is fundamentally different and much more enabling that the FinTechs can do compared to the banks. It's a different discussion altogether why the banks are slower or taking longer, and part of it is regulatory. But I think because the experience, and I see that as sort of a constant for foreseeable future. And that being the case, the point, the interaction with, there's that old saying, he who enrolls controls. Because the FinTechs are going to be the first point of contact, there will need to be, I believe there will sort of be a forced coming together. And FinTechs need a quote-unquote FI, something that is regulated. Because if they're regulated, then they become banks. And so there's very little middle ground here. So I see this, the banks playing a supportive role, almost a necessary role, they have to. FinTechs playing an accessory role because they are the ones who are most agile in terms of building the experience. I can take multiple examples, like even within FinTechs, if you look at a bunch of payment companies, PayPal, Square Cash, or there's Zelle, all of these are payment mechanisms that enable the sender to send money out. But what about the recipient side? They all ask the recipient to enroll or to create some kind of account. And what we did was we did it in a way where the recipient doesn't have to do any account creation. It just comes in, the digital check just comes into the email. And this is not, touting ourselves. It's sort of a common theme that I see across the fintechs, that the user experience is so much more engaging that is pulling the people in, but they still need the back end, the money movement side from a regulatory body, which is the banks and FIs.
Well, so the customer experience is the tip of the iceberg when it comes to why people are making the switch from banks to fintechs. A bigger reason why people are really making the switch is the unit economics are a lot different. So Chime is able to provide an account at zero cost. Acorns is able to provide an investment account at zero cost. Schwab and Bank of America are just incapable of doing that. And that ends up making the decision. So much so I'd sometimes say that even if they had a bad user experience, they would still get the customers to switch because the economics work out so much more favorably in the customer's favor. This happens both ways. This happens with consumers in America and also banks, also businesses and banks. What's happening with businesses in case of like any infrastructure company like Synapse or Checkbook.io, people can go direct to banks and get some of these products. Banks don't give them access to these products. So even if we did not build out good software, but the only thing we did was had consistent access given to these businesses, we would still succeed because banks don't give that to them. And now we cannot give everyone access in a consistent and at a cheap cost without good software. That's a different point. But why people are making the switch today, maybe businesses or individuals, goes down to the fact that they're getting much favorable rates with financial technology companies than they are with banks. That's what fintechs have going for them. And they finance this two ways. The most common way is VC financing. Like, it's not that most of these companies have such low unit economics per customer, it's just a bunch of money. They're just going to subsidize that for the longest period of time in the hope that they can optimize their software with their bank or with third parties, that their cost per customer goes down over time. If that happens, then they would be able to make a more sustainable business. If that doesn't happen, when the funding runs out, it runs out. There is no business model innovation substantially that has happened in fintech yet, other than the assets under management market, where Acorn and other people have decided that they're going to charge customers $1 a month, and that has been probably the most successful business model pivot so far from a consumer standpoint. But that's what fintechs are good at, being able to provide some of these services at a subsidized rate. Not a lot has changed on the infrastructure side. What banks have been good at, which is they have a lot of capital. So why people go and sell their loans to Chase or Wells Fargo is because they have the capital, and fintechs just need some of their money back because it's like a skinny kid between a bunch of sumo wrestlers. Like they're gonna take some help. If that dynamic can change over time, which is probably like some companies like Square get super big, and they don't really need Chase's balance sheet anymore, they wouldn't sell the loans to Chase. Like, there's almost no reason for them to do it. The only reason they're doing that is because they want some of their liquidity to open up to go and engage more customers. And Chase has the balance sheet to be able to offload these things on. So I know it seems like it's kind of collaborative, but it's more so because regulators have forced both parties into this corner where they have to collaborate, which might be a good thing. But over time, you're going to see some of these like companies, as they get bigger, probably would try to look more like banks and less like technology companies in itself.
I think to that point, there are different ways that it could jump off from here. I mean, depending on the fintech company, they may be deciding that they want to focus on owning that customer and passing that data along as the asset and being agnostic to whatever ultimate bank is on that side. That's one play. Another play is you do start to build up assets, secured or unsecured, and you want to start having a balance sheet and open up the liquidity options. One could try to maybe get to a critical size and become a chartered institution and get all the compliance that comes with that and cost, or stay out of that completely, and that's where you get it goes from competition maybe to collaboration, and it is symbiotic. You source it, but then you get your liquidity by selling it off, and then you continue building that customer experience. So I think over the next few years, we're going to see all sorts of kind of business model alternatives. And you know, from the liquidity side, there is something to be said about leverage, but then there's a big cost to that too. So I think it's to be determined how there's not going to be one business model size fits all. There are going to be different jumping off points.
It's interesting you mentioned the data play. A lot of banks have been opposed to sharing the data, and I know this might be a contrary viewpoint, but they're smart in doing so. Even as fintech companies kind of like start acquiring more customers, maybe a firm, Chime, like Acorns, it would suit them well if they did not share that data with other parties. One thing that a firm does very differently than most lenders is they do not report back to the credit bureau. And you initially think that's like a silly idea. Why would you not want to do that? Well, here's why. As a firm starts building their own history on these customers, they are the only ones who own that data now. No one else does, which means they are more likely to be able to provide better service to most people than anyone else. Why would you share that data with anybody? It makes no sense. So right now, kind of fintechs are like fighting banks, and they're like, you need to be able to let us see this data. But as these players themselves get bigger, if they're wise, they would not want to share this data, because that's where all the important elements in customer experience would come from, because you would be able to onboard and service people much, much faster than someone who's just starting out or doesn't have access to that data.
But but that the trend is that I think some banks are starting to share that data, right? So that's what you're saying. It's a more controversial or against what's happening.
Yeah.
I think that just happened.
PSD2 is one initiative in Europe, and there's a bunch of initiatives going on in this country where the regulators are coming in and saying, the customer is the one, the end user is the one that owns the data, and they're mandating the FIs to do certain things that hitherto were just not expected.
So there are two pieces to the data. One is the account portability piece, which means data that you really, really need to be able to move someone's account from Bank of America to Chase. And then the other piece is the piece that's the consumer behavior piece in terms of how does the consumer access different financial services, and how have they performed in the past? People are going to keep on fighting on it. Maybe regulators would come in and say all of this just needs to be open and available to everyone, and that's likely. But very key architectural choices that even successful fintech companies are making are contrary to what we all claim needs to happen, which is we need to be able to make this data open and accessible to everyone. But most of the large players in fintech do not do that, because they know that's not wise for their business model.
So yeah, core data has to be, sooner or later it's going to happen, and it's going to be sooner. But the behavioral data, that's going to take a while, because that field is just emerging.
So I know we've been talking a little bit on the regulatory front now. We've touched on it, I think, in 3 or 4 different of the responses. I'm interested in actually, before I go into that, something that was mentioned, I think, by Lisa, was that the fintechs, they don't have this base, they don't have a deposit base. They sometimes they will have the ability to grow a loan portfolio, securitize it, or sell the loans off to a bank, and that all does happen. But we know there was the news on the FinTech charter at some point for banks that I feel like is getting a little less publicity as of recently, as of late. But just on the regulatory front, and the FinTechs being less regulated, I won't say unregulated. I know CFPB comes in and other regulators, but what's on the horizon? What does everyone think is going to happen maybe a year, and then I'd say just 5 years out as far as regulating fintechs? Some of that could be through partnering with banks. I do understand that, but.
Well, so I'll start, but so it's not that fintechs are not regulated; they're indirectly regulated, and a bunch of these obligations that the bank has with the Fed or FDIC or OCC, whoever their primary regulator is. By the way, every bank has a primary regulator in one of these 3 people. Any obligations around operating your business get passed down to the fintech in itself. So they have to kind of perform some of these obligations and give the bank comfort that they know what they're doing, maybe around the compliance space or ledgering space, but that's kind of unlikely. It's less about who books the balance. One thing I realized, which is like kind of a new interesting learning to me, it's less about who books it on their balance sheet or the deposit base. The most important question you should ask yourself is who owns the ledger. Because whoever owns the ledger can really own the customer experience. Here's how. If you work with Bancorp Bank and open every deposit account for your customer with Bancorp Bank in their core bank, once you move your banking partner, it's going to be a pain to be able to transition all of those accounts off. Simple went through that struggle when they moved from Bancorp Bank to BBVA. It was years-long process before they could do something about it. If companies on top of Bancorp Bank were structured in a way where they owned the ledger and kind of like Bancorp trusted them with the ledger and just audited them on a regular basis, very hard sell, by the way. But if they could do that, and with Bancorp Bank they just had a general ledger account, then they can wire all of the money out of Bancorp Bank overnight and move it to another bank, unless they have some legal obligations where they cannot do it. But then at that point, customer portability becomes very easy because it's clear who owns the customer. And the bank is kind of just like there to be able to house the deposits, which is still a good relationship between the fintech company and the bank, but it's inherently different. So it's less about the balance sheet, like who balance sheet it really sits on, more about who really owns the ledger that's going to decide who actually owns the customer.
So my cross on this is fairly simple. I think the regulators, there's going to be pressure from fintechs to ask the regulators to make core data portable across different FIs. This happened, about 10 years back in the cell phone industry, 20 years back when cell phones kind of got taken off. It took about a decade or so before number portability was mandated by the regulators. And when it happened, it happened. Everybody's got the same phone number across different carriers. That, again, it's a question of time. I don't know if it's going to be 1 or 2 years or it's going to be 3 or 4.
That cannot really work in banking because every bank has their own routing number, so you cannot really port.
That's the way it is right now. But once you mandate it, I mean, trust me, once there's a mandate, like Social Security numbers are going to go away from Equifax. Okay? 3 years. It took 3 years for chips to happen, and before 3 years, everybody said, no, wait a minute, chips can't happen. It's going to take a decade. But the federal government came in and mandated, it says you're going to have EMV, and the chips started appearing on the cards in 3 years. So we can debate about the amount of time it's going to take, but it will need to be mandated and happen. And again,
it's not the amount of time here. You have to change core protocols. You have to change how BIN and work.
I trust, core banking is core. It's been there for decades. Some of these systems have been running for decades uninterrupted.
But this is not a function of core banking. This is a function of like networks, like ACH works with ABA numbers and routing numbers. Interchange works with BIN numbers.
And there's nothing to prevent a new layer coming on top of it. So anyway, we can debate about it.
This might be a good spot for Chime to chime in.
That's what I was going to say.
So a couple of thoughts. So you made a great point, which is fintechs are highly regulated. It's not like Chime just decided that we were going to be a fintech and start a checking and savings account and we can do whatever we want. Like every single product change my team makes has to get approved by multiple committees at the bank that we operate with because they are pass-through regulating us on behalf of the FDIC, Fed, or whatever. So it's actually one of the challenges of innovating in this space. There's really two primary challenges. As a consumer technology company, we are better than the banks at putting ourselves in the shoes of the customer, understanding their needs, and building an amazing user experience. I want to pivot back to talking about that in a second, because I agree that whoever owns that customer experience has an enormous position of leverage when it comes to growing with that customer over time and eventually disintermediating banks to a large extent. But going back to my original point, so what was I saying?
The regulatory, that fintechs are regulated.
So unfortunately,
Yeah,
we're
we're
just
out of
right
time.
getting into the meat of it, and we're going to have to call the panel. So any last final thoughts we want to go through? Maybe one quick final closing word?
Yeah, I'd rather if my last words were not, what was I saying?
Yeah, let's let Zach finish this off.
Look, We actually don't spend a ton of time concerned about the question of like who owns a ledger is actually a really interesting one. In our case, we actually have a processor who sits on top of the bank is the one that actually kind of owns a ledger, but we keep a copy ourselves. We've talked a lot about portability and thought through that. We're not super concerned about it. I just kind of like the broader point that like the next big front in fintech, in my opinion, is going to be the core bank account. Every big fintech has said, if you look at Earnest, SoFi, all these lending fintechs, they've said, this is really just our wedge into the space. We're going to acquire customers really profitably to lend to them, and then be able to grow with them to the point where we become a primary bank, their asset manager, et cetera, over time. Everyone seemed to think that actually starting your bank, that's where I was going with this. It's actually really freaking hard to start a bank or anything running on top of an existing bank, acting as your bank account because of all that pass-through regulation. It took Chime years to set up those relationships and to figure out how to operate this and to do it profitably. I think we're really the first ones that have really figured that out. That is the ground zero of the fintech wars starting in 2018. The European banks that have figured it out, startup banks, are moving over. The existing fintechs like Square and PayPal and Venmo are turning into deposit accounts and issuing debit cards to millennials. And you're going to start to realize that the interchange business that smaller banks can operate is actually enormously profitable. And once you own that relationship, moving up market into not just savings, but investing, refi, origination is a no-brainer. And then the incentive is just to disintermediate those banks wherever you possibly can until you ultimately get a bank charter. It is going to be really interesting 5 or 10 years. But if you think that this frenemy thing, like where fintechs and big banks are like dependent on each other because fintechs don't know how to deal with regulation, you're kidding yourself. It's going to be a bloodbath.
Yeah.
We're really excited about it.
Stop.
Yeah,
I think
because
we'll,
the members are going to win. It's consumers that are the ones that are.
We'll end on the word bloodbath.
Oh, God.
So that was
better
awesome,
than-
guys. So I'm glad that we're getting some good conversation going here. So we'll continue it. Let's continue this conversation at lunch. We've got a couple great panels and speakers coming up here. So if we'll bring up our next panel here. Thank you so much, Ryan, and the rest of the panel.